bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac. This is Tax Credit Tuesday. This is the May 13th, 2025 episode. My guest this week is Brent Parker. Brent's a partner in Novogradac's Long Beach, California office, and he is one of Novogradac's leading experts in a number of tax incentives, including opportunity zones, which is the focus of today's episode. Now, Brent and I are recording this week's episode on Friday, May 9th. You might be wondering why I'm focusing on when we're recording this. Well, we're awaiting the release of details of a Ways and Means tax bill in advance of a markup by the Ways and Means Committee that's scheduled for the day that this podcast will air. So if the markup is not postponed, then we should see details of that Ways and Means tax bill in advance of the Tuesday markup. Now for today's podcast, as we await the release of the Ways and Means tax bill, Brent and I are going to continue a recent theme of episodes of Tax Credit Tuesday, and that is combining various tax incentives. And today we're going to focus on discussing combining opportunity zones with other tax credits, namely renewable energy tax credits, low-income housing tax credits, new markets tax credits, as well as historic rehabilitation tax credits. Now, let me note that we do expect the Ways and Means tax bill to include language to modernize and renew the OZ incentive, which we commonly refer to that as OZ 2.0. I did ask Representative Darren LaHood earlier today, Friday, May 9th, about the status of OZ legislation. I asked him that as he was a live virtual keynote at our Novogradac Housing Conference in San Francisco. He was not able to be in San Francisco for the event, but did dial in live. His response to my question did confirm my optimism about the Ways and Means tax bill extending and making permanent opportunity zones. Now, our discussion today, Brent and my discussion, is going to focus on existing tax law and how various tax credits work with OZs under existing law to spur community development. Now, let me note, and Brent and I are discussing the combination of opportunity zones with other tax credits. I view the ways in which transactions are structured as one of two forms. One form is twinning, and the other I refer to as sidecar financing. When I think of twinning from a structural perspective, the same investor is providing equity for multiple tax incentives to achieve the goals of each. And in a sidecar financing, a development is structured as two separate and distinct transactions with equity from different investors. So it's a sidecar financing or twinning. Let me also share with all of you that we are in the planning stages of an Opportunity Zone Summit this year. We're scheduling the summit to take place on Wednesday, December 3rd in Las Vegas. That'll be the day before our annual Affordable Housing Conference in Las Vegas. And we do hope that we'll be discussing at that time a new Opportunity Zones law and how the implementation of that law will go. Now, we haven't started online registration for our Opportunity Zone Summit, but I do encourage you to email our event staff at events@novoco.com to reserve your spot for the OZ Summit. I expect it to be very popular. Also, you can learn more about other upcoming Novogradac conferences at novoco.com/events. Brent and I have a lot to discuss today, so if you're ready, let's get started. Brent, welcome back to Tax Credit Tuesday.
Thanks, Mike.
This is your 8th appearance on Tax Credit Tuesday, firmly into the top 10 guests who appeared the most. You're tied with housing policy consultant Mark Shelburne. But with all of that said as background, you've obviously been on a number of times describing the services you provide to clients. But for the members of the audience who haven't seen your previous appearances, please do describe some of those services that you provide.
Definitely. So I do all the fun and exciting things accountants, CPAs typically do. So statement audit, preparation, various agreed upon procedures engagement, which, most of the tax credit industries and the OZ incentives are used for various reasons, particularly to sort of demonstrate compliance. I also perform a variety of consulting oriented services, such as helping clients model transactions, and the OZ world helping to draft working capital safe harbor documentation, which is extremely important and probably the first thing the IRS would look at if they audit you. Due diligence in closing equity, debt, and grant transactions, among other things.
So thank you for that. And I will include your email address in today's show notes for those that want to reach out to you. Now, this Tax Credit Tuesday is really an OZ 200 course in the sense that it's advanced, as we've talked about combining opportunity zones with other tax incentives, either through twinning or sidecars. With that said, I do feel like we should have, a 100 course briefly about the basics as to how investors in opportunity funds use that investment to spur equity investment in distressed community businesses. So if you could just give a very brief overview, and we'll link to other podcasts that give a little more detail on some of the basics, but just to level set.
Sure. Yeah. So an OZ investment, can be used for real estate oriented businesses. It can be used for operating businesses. Usually we see it for real estate oriented businesses for a variety of reasons. It's a little bit different than a tenant script investment, where OZ return is sort of largely based on residual value of the project. Investor comes, invests, something proportionate to capital gains into the fund, invests in lower tier business typically. And then, investor has their taxes deferred on gain until some later date. Right now it's December 31st, 2026, but we'll see what happens with that. And then if they hold their investment for 10 years, the appreciation on the gain for federal purposes in most states becomes tax exempt or tax free. So they have to hold their project for 10 years. It's very similar to typical sort of private equity in a lot of ways, except for the investors hold is longer. But from the developer standpoint, it's very similar. Developers sort of earns developer fee, management fee, carried interest. Sometimes they get out at stabilization with like a crystallization event. Sometimes they like to stay in, and sometimes a developer will split their return between the development services and an actual qualified opportunity fund of their own.
Brent, thank you for that. And I think the audience knows that right now, to be eligible, investors have to invest capital gains, but there has been a push among a number of modernization recommendations for Opportunity Zone 2.0 to allow ordinary income to be invested. That was something that the Opportunity Zones Working Group and a number of others have recommended to Congress. So we'll see if that makes its way into the House Ways and Means bill, and if not there, if it makes its way into the Senate bill or otherwise is an enacted change. But now let's talk about the combination of opportunity zones financing with other tax incentives. And when we were preparing for this episode, we were discussing which types of tax credits or opportunity zones combined with the most. And one area where I know you do see a lot is combining opportunity zones with renewable energy tax credits. So if you could describe for the audience why renewable energy tax credits get combined fairly frequently with opportunity zones, obviously when the renewable energy, the property is going into an opportunity zone, why you see that being combined.
Sure. And I think, I want to start out by saying, each of the credit programs can work very differently with opportunity zone incentive, but each in their own sort of powerful way. As you mentioned, I think originally when financing a deal, the incentive is either twinned or it's, used in a sidecar sort of QF investment. Often with renewable energy tax credit developers, sponsors sort of have to contribute some meaningful equity. And so the tax credit equity from that standpoint, the sponsor equity can be sort of used also with OZ incentive. Sometimes the tax credit equity, there are basis limitations and reasons why for renewable energy purposes it may become difficult to structure the twinning of the tax credit with the OZ incentive. But for sure, it can be used on the sponsor side. That's one of the great things about the Inflation Reduction Act 2022 is credits are now transferable and can be effectively kind of sold to outside parties. So traditional QSEBs looking to acquire property that's in use can develop renewable energy property to meet their substantial improvement requirement and then sell the resulting ITCs. Depreciation on the renewable energy property remains with QSEBs reduced by half the credit, and it's allocated to investors. And then the tax credit sold result in tax-exempt income to the QSEB, which is allocated out, provides basis upon which to take the distribution. So it's very powerful, and it can help you meet your compliance requirements from an OZ perspective, and then still add in all of the great benefits of ITC.
No, that's a great overview. The only thing I would sort of add is another unique aspect of renewable energy transactions relative to other property-based transactions like, real estate, call it, be it commercial or residential, is a very short depreciation period and the potential for expensing of a portion of the property and then depreciating the balance over 5 years, such that at the end of that 10-year period, an asset will be obviously fully depreciated, and any gain can end up doesn't have to be recognized if it for those that invested through the QOF and obviously held the investment for 10 years. So there's that aspect of it as well. The gain recognition aspect of it, if you will, can be a lot more than in a real estate transaction where the building itself has a longer depreciable life.
Certainly. And, with the right debt, you can take a lot of this action front, even, if you're sort of not taking deductions on the credit portion until 2026. But again, then it can offset your gain at 2026. So yeah, it's fantastic.
Now, and I recognize for some of our audience, a lot of what you said, you and I know what that means because we've done the modeling and we've seen how the losses flow. We've seen how the basis goes back and forth and the rest. So I know a lot of our audience probably aren't as conversant with that sort of modeling, but it does show just the importance of the financial models sort of up front. And when you combine opportunity zones with any of these various tax incentives, the modeling becomes all the much more important in terms of understanding how the opportunity zones rules work and how that affects the transaction from the standpoint of the other tax incentive. So let's move on now to opportunity zones and low-income housing tax credits. Tell me and tell our audience what motivates developers to combine OZs with low-income housing tax credits.
Yeah. So in the LIHTC world or low-income housing tax, developers, earn their return typically through developer fee, ongoing incentive and partnership management fees, and then a majority of the proceeds on ultimate liquidation or capital event, inure to the developer after the tax rate or compliance period. So traditional investor is primarily interested in the credits and tax losses and some residual value, but a major factor is ability to earn CRA credit, which is extremely attractive to banks. Under the sort of current framework, in order to receive benefits from OZ incentive, investors have to sort of contribute funds proportionate capital gains, like we said. And banks sometimes don't have programmatic capital gains. So we've seen insurance companies, other investors effectively twinning OZ incentive with LIHTC and helping their return. And we certainly hope and are looking forward to OZ 2.0 and to see banks sort of more involved in that space as well. But in the meantime, when investors don't have capital gains, OZ incentive can be used to fill equity gaps using sort of side corp vehicle as well, make maybe a 4% project more viable. Also, to the extent developers need to invest additional GP equity, which is very common nowadays, I feel like, this can be used to provide added benefit to them. Investor, a GP is rolling off another deal and they're, realizing a bunch of gain. They can invest, they can create a QOF and make that equity investment into the current deal for their equity portion.
Yeah, I appreciate you pointing out that banks don't have programmatic capital gains because that initially there was a expectation, certainly that I had, that banks would become greater investors or be motivated to invest greater amounts of equity in locally attached transactions that were located in opportunity zones. Unfortunately, the way in which the law was interpreted, it had to be capital gains, could be other types of gains. The statute itself isn't clear, but the regulations are clear that it has to be capital gains. And as a consequence, banks not having programmatic capital gains weren't able to take advantage of opportunity zones when they invested in properties that were located in opportunity zones, which means they weren't able to invest as high an equity price as they'd be able to invest if they could. There have been a number of recommendations that the Opportunity Zones Working Group and others have made to try to align opportunity zones better and incentivize the ability to combine the two together to drive higher equity pricing. And probably the number one change is allowing the investment of ordinary income. But there's also been other recommended changes that Enterprise and LIHTC and others have joined in with the Opportunity Zones Working Group to make to Congress to try to, increase the level of activity here. So we'll wait and see.
Hopefully not too long.
Yeah, hopefully not too long, but it's not too long until we get the first release.
Yeah. The outline.
And it'll be certainly long in terms of having to make it way through the Senate and before it gets to the president's desk, but it'll be definitely very interesting to watch.
We're all very excited. And I think I just want to forecast, we're going to have a webinar coming up right after the proposed legislation is introduced. So, keep tuned, stay tuned for that.
Yeah, good point. I'll include a link to that in the show notes. So let's now talk about new markets tax credits. So new markets tax credits are closely aligned with opportunity zones, or maybe I should say opportunity zones are closely aligned with new markets tax credits because new market tax credits were first created back in 2000. And new market tax credits have a concept of low-income communities, or a definition of low-income communities that are considered distressed based upon certain criteria. And those zones are obviously kind of throughout America. And opportunity zones are low-income communities that actually reference the new markets tax credit definition of low-income community. And every governor was able to select order of their new market tax credit low-income communities to be opportunity zones. And the new markets tax credit, as you know, is a very deep subsidy, but has a cap in terms of market size that can be very limiting in terms of the availability of new markets tax credits for various businesses in low-income communities. Whereas opportunity zones doesn't have any type of equity cap, but as you noted, it's a shallower subsidy, and opportunity zones investments do need to generate a cash economic return, albeit less than if it was a market return because of the opportunity zones benefits, but still, it needs to be projected to generate a cash return to attract investor interest. With that as a background on new markets and opportunity zones, please share with our audience in which types of situations you're seeing new market tax credits combined with opportunity zones, and how often you see twinning versus sidecars.
Certainly. And just to give a little background for folks that maybe are on the OZ side of this and not the new market side of this, new markets are typically sort of generated on investment that are made into entities that are lending entities typically, but are typically lending entities, which creates sort of issues with OZ compliance. So you don't really see a lot of twinning there. Ultimately, the loan in the new market side is made to an entity called a qualified active low-income community business, or QALC-B. And so the QALC-B will then be this borrowing entity, and maybe 20, 30% of their capital stack might be a new market loan. But that QALC-B, certainly can be financed with a QOF proceeds. Some of the benefits here are that the new market tax compliance period is 7 years. So that matches up well with the 10-year OZ period. And the QALC-Bs have very similar, even going to the same Internal Revenue Code requirements as qualified opportunity zone businesses. So including limitations, cash issue, cash limitation, other assets, and gross income requirements. So there's a lot of overlap, and certainly QALC-Bs, I've seen a lot of QALC-Bs that are financed with the funding.
Yeah, thank you for that. And I appreciate you pointing out that with new markets, you generally will see sidecar investments. I think with renewables, you'll see a lot of twinning, or at least some version of twinning for some of the investors in the renewables. And then similarly with low-value tax investments, you'll see the twinning as well. Yeah, you mentioned with insurance companies and the like, as well as the developers themselves putting in equity capital through a qualified opportunity fund. But with new markets, as you pointed out, new markets, generally they're making loans, which aren't equity investments. So they're making loans to businesses, which, as you pointed out, in new markets tax credit language, the new market tax credit entity is lending to is considered a qualified active loan community business, or QALICB, whereas the qualified opportunity fund concept for OZs are investing in qualified opportunities on businesses or QASBs. So they could be a QALICB and a QASB. And I haven't confused the listeners or the viewers.
Maybe we should have started with like a list of acronyms or something, but yeah, there's no lack of that.
No, there is definitely no lack of that. And that's maybe one of the benefits of the podcast is you can be listening and just hearing the acronyms and the words and maybe listening to it a couple of times to start to learn the language. But one of the recommendations that the Opportunities Working Group has made with respect to new markets is a regulatory change to what we commonly refer to as the control test. And one of the reasons why new markets is driven towards loans is because of this control test. And that if the control test was modified, you might see more new market transactions being equity investments as opposed to debt, which might lead to more twinning versus sidecars. And with that level of detail, maybe we should move on, or anything else you want to say about new markets and opportunity zones?
No, I think you said it great. Thanks.
So the fourth area that we wanted to cover, and then we'll leave it at that, is combining opportunity zones with historic tax credits. Once again, if you could share with our audience some of the benefits of this and any particular issues that they should be mindful of.
Sure. Just to sort of give you a background on HTC or historic tax credit structures, this is a credit traditionally has been 5-year compliance period credit. It's sort of earned in the first year, but
let's just say it, as you know, it used to be earned in the first year.
Yeah.
And because of the lowering from 25% down to 20%, it's a 20% credit. It used to be claimed the year the property was placed in service, but with the Tax Cut and Jobs Act, instead of claiming it in the year the property was placed in service, it had to be claimed ratably over 5 years. And then the compliance period is over 5 years. And there is an effort through this tax bill to get it back to being a 1-year credit. And we'll have to stay tuned on that front. So now it's basically a credit that's claimed ratably over 5 years. And hopefully we'll get back to the 1 year that was in effect before 2017. I'm going to say
Right.
team, but it was really, there were phase-in rules and things of that nature. So a number of transactions after 2017 continued to claim the credit in the year the property was placed in service 100%. And now it's operates as a 5-year credit. So with that as a kind of additional context for our viewers.
Yeah, thank you. I was sort of projecting, thinking, the 1 year. Well,
Yes, I put it out there, make it think it's so it'll be so.
Hey, will it? So typically it's been this 5 years thing. So there's, what you'll see equity investment. You'll have two different types of structures. Typically you'll have a flip, so equity investment that then after the 5 years, the majority ownership sort of flips over to the developer, or, in a master lease sort of structure. So from a, qualified opportunity fund perspective, you can have, qualified opportunity fund equity come into a structure. And then, after 5 years, from the HTC equity, the percentage ownership flips over to the QF. So when you get out to your, real benefit from the QF, which is the 10-year gain elimination, you're getting that, those proceeds distributed out to the QF and getting the benefits to the QF. So that's why, you see a lot of sidecar type of stuff happen there. Not to say that you can't have twinning, you can. It's just a longer hold period for HTCs. And from a compliance perspective, there's a lot of overlap. So from a compliance perspective, each has a substantial improvement requirement, and then also the development timing requirements. If you're meeting them for HTC, probably going to meet them for OZ purposes. So it's almost like a no-brainer from that perspective.
Yeah, I do think that when you're doing the modeling, as you were sort of noting, there's generally what I call a straight up transaction where the investor for the tax credits in project is partners with the developer. And then there's a master lease structure. And this is also true for renewable energy tax credits as well, where the project partnership itself leases the property and under a overall lease of the property, 100% of the property, the prime lease, as it's called, the prime lease to the entity that's going to be claiming the tax credits. And when you're dealing with sort of the straight up transaction, both the investor and the developer can be thinking about investing in the business by virtue of an opportunity fund. And when you use the prime lease structure, then the property itself, it's something a developer can be thinking about investing equity directly in through a qualified opportunity fund. However, they get into the prime lease issues and triple net lease issues and other more technical issues, but it does create opportunities for the developer as well as the tax credit investor. So
Should we talk about,
Good.
sorry, we shouldn't talk about like inverted leases or is that the Brio one or?
No, exactly. Inverted leases, back leverage,
Yeah.
completing various types of language. So Brent, I appreciate you being on the podcast and discussing these various ways in which opportunity zones are combined with other tax credits. Obviously, we haven't provided enough information for clients to run out and actually structure these sorts of transactions. Hopefully, though, we did give our audience a sense as to how this can be sort of combined, and that the audience is thinking about, their various developments. And if they're opportunity zone centric, then they can be thinking about the businesses that they're investing in opportunity zones and whether or not they're entitled to these other tax incentives. And if so, reach out to you to help structure it. And then on the flip side, for those that are out developing and, developing clean energy, renovating historic properties, building affordable housing, financing community development facilities, if they are in a low-income community, and obviously new market tax credit transactions will be, or they have a 25% chance of being, I should say, that they should be looking at bringing in opportunities on equity, thinking about whether or not there's a role for opportunities on equity to play in those transactions. And hopefully this podcast did give some food for thought, if you will, with respect to that. Now, when we were talking about the podcast and preparing for it, we noted that we scheduled this discussion of combining opportunity zones with one other tax incentive. Now, that there's no magic to just one other. There can be multiple others. So you could have a opportunity zone investment in an historic tax credit transaction that also has new markets. You could have new markets as a sidecar to a low-income tax credit transaction that has opportunity zones. So there's definitely ways in which the incentives can be layered together beyond two.
And just to,
Right,
if I could jump in, should I jump in or can I?
Yes, jump in.
I'm sorry.
No, don't apologize. Jump in.
No, because it just made me think of something.
Yes.
I mean, like with respect to, comparing things, and not just credits, it's other incentives like grant incentives and things where that might even help you to sort of meet, incidentally help you to meet opportunity zone requirements.
Yes.
Because depending on what grant you're getting, if it's taxable or whatever, but these things can work very powerfully together and, make deals work that wouldn't otherwise happen.
And obviously, as you layer in more incentives, it does lead to a greater level of complexity and compliance. But I would just tell our audience, kind of rest assured that we've done it before, and everything will be more complex to the audience if they have not done it before than it will be to us, having done it before, having the models where we've dealt with a number of the issues. Not to say that we've dealt with all the issues that can come up, but there's lots of experience out there combining the multiple incentives. And the number one piece of advice I know you join me in sharing is just make sure you're working with, professional service providers that have worked in these areas before. So Brent, I mentioned earlier that I'll include your contact information in the show notes. so our viewers can reach out to you. But before I let you go, I would like for you to share other resources that you would recommend our audience turn to in addition to reaching out to you directly.
Definitely. We have an opportunity working group, which is very active. I think hopefully we'll see the 2.0 will look very similar to letters that we've sent, or a letter in particular that we've sent recently to Congress and key stakeholders. So, our working group is actively involved in, it's some of the top people in the industry, fund sponsors, developers, attorneys, et cetera. So just a great resource there, and you can get that from our website. And then, we have a series of events. We have tons of events that are fantastic. We've just wrapped up our San Francisco affordable housing event, which I led the year 15 workshop, which is the Wednesday before. And it was fantastic. We had a great turnout. We have an OZ summer coming in December on December 3rd, and that's going to be at the Four Seasons in Las Vegas, which is a fantastic venue. And it's going to be followed up immediately after that on the 4th and the 5th by the Affordable Housing Finance Conference at the same location. So hopefully we'll see a lot of, more overlap with affordable housing, and it'll be a very powerful pairing. And then also we're going to have, we have other conferences. So we have a New Market Tax Credit Conference coming in October, Historic Tax Credit Conference also in October, and various other. We have New Market Tax Credit Conference in June, and then we have a Renewable Tax Credit Conference next week. So I think, Mike, you're probably going to be pretty busy.
I am going to be very busy. And I will note that our New Market Tax Credit Conference in June, we do have Ways and Means Chairman Jason Smith is scheduled to provide a keynote address. So we'll be very interested in hearing what he has to say. And we hopefully will have a tax bill that the House has passed by then. So it'll be interesting to hear his comments as the bill makes its way through the Senate. Or if for some reason you don't have a tax bill yet through the House, it might be even more interesting to hear what he has to share with us. So I'm super excited that the chairman is joining us yet again at a Novogradac conference. So Brent, I do want you to stay on for our off mic section. But before that, let me remind our audience to subscribe to the podcast on whichever platform or platforms you get your podcast. I actually subscribe to it on a couple of different ones. And if you're watching on YouTube, I encourage you to like or comment on the video. If you like or comment on the video, it helps raise our visibility. It helps others in the opportunity zones and other tax incentive communities hear and see discussions like the one Brent and I had today. And I also encourage our audience to share the podcast with colleagues. It's a great way to get them started on such topics as the opportunity zone incentive. Also a way for them to learn a lot more in depth about the various incentives. Like today was definitely much more of a upper division than a lower division course. And we do have a full archive of our episodes available on our website at novoco.com.
I was going to also say, if you watch on YouTube, then you can see how cool my shirt is, but you can feel free to.
It is very cool. And it made me think of our conference that we're working and planning in Hawaii in September.
That's right. And that's exactly why I bought it last year.
So now we've reached our off mic section, and we'd like to use this space to give a shout out to others working in the tax incentive community. It's an opportunity for my guest to highlight someone who deserves recognition. So Brent, who would you like to give a shout out to? And let me just say that there's a lot of people you can give a shout out to. So if Brent's not shouting you out, don't be offended. Just tell Brent he needs to be on the show more often. You have more opportunities to shout someone out.
Yeah, there's, so many great folks in these industries. But the one person I want to shout out today is Mark Schultz, Snell Wilmer. He's an attorney who's very prevalent in all of these areas. He works in all the tax credit areas and opportunity incentive that we've discussed, and is one of the leading people in those spaces. So I wanted to mention Mark.
No, thank you. I second the shout out to Mark Schultz. Mark and I have been working with the opportunity zones and other tax incentives since the beginning of Opportunity Zones and before. And I give kudos to Mark for embracing a new incentive and the ways in which it can work with other incentives. So let me just say that was an excellent shout out, Brent. So I'll indirectly give you a shout out. So Brent, thank you for being on the podcast today.
Thanks, Mike.
And to our audience, I'm Michael Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novaco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novaco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novaco.com.